Have you ever stood in the ruins of the Roman Forum and wondered, how did the greatest empire in history just vanish? I'm standing here in 2026, watching America's national debt clock tick past $36 trillion, and I can't shake this eerie feeling. The Romans didn't see it coming either. Today, we're going to walk through history's most expensive lesson, and trust me, by the end of this video, you'll understand why your wallet, your savings, and your future are all caught in a cycle that destroyed Rome 1600 years ago. But here's the thing. Unlike the Romans, we can actually see what's coming, and more importantly, we can prepare for it. Let's rewind to 117 AD. The Roman Empire stretched from Scotland to Syria, from Spain to the Sahara, over 5 million square kilometers. 1 in 4 humans lived under Roman rule. But empires this large? They're expensive, really expensive. The Romans had a problem we'd recognize instantly. They were spending way more than they were making. Rome maintained roughly 30 legions, about 150,000 professional soldiers, plus auxiliaries. That's around 400,000 men under arms at any given time. And they weren't volunteers. They expected salaries, retirement packages, land grants. Sound familiar? In 2026, the U.S. military budget sits at over $850 billion annually. We maintain approximately 750 military bases in 80 countries. Rome had military installations from Hadrian's Wall to the Euphrates River. The Romans kept expanding because each new territory was supposed to pay for itself through taxes and plunder. But here's what they discovered the hard way. Occupying territory costs more than conquering it. Every province needed garrisons, administrators, roads, fortifications. The return on investment kept shrinking while the costs kept climbing. Now here's where it gets really interesting and really relevant to your checking account in 2026. In 64 AD, under Emperor Nero, a silver denarius was 90% pure silver. By 200 AD, down to 50%. By 270 AD, just 5% silver. The rest? Cheap base metals with a thin silver coating. The emperors literally watered down the money supply. Why? Because they had debts to pay, soldiers to satisfy, and building projects to fund. But they didn't have enough tax revenue, so they cheated. They made more coins with less silver, paid their bills with debased currency, and hoped nobody would notice. People noticed. Prices skyrocketed. A measure of wheat that cost half a denarius in 200 AD cost 50 denarii by 301 AD. That's 10,000% inflation in 1 century. Workers demanded higher wages. The government demanded higher taxes. Productive citizens fled to the countryside. The economy spiraled downward. Since the Federal Reserve was created in 1913, the US dollar has lost approximately 97% of its purchasing power. What cost $1 in 1913 costs about $31 in 2026. That's not a conspiracy theory. That's the official Bureau of Labor Statistics data. But here's the kicker. Rome took 200 years to debase their currency by 85%. We've achieved 97% debasement in just 113 years. We're actually outpacing the Romans at their own game. By the 3rd century, Rome faced relentless pressure on its borders. Goths, Vandals, Huns, everyone wanted in. Some came as refugees seeking a better life. Others came as invaders. Rome's solution? Pay them off. The empire spent enormous sums in tribute to barbarian tribes, essentially bribing them not to attack. When that didn't work, they started hiring barbarian mercenaries to defend against other barbarians. Think about the economics of that. You're paying foreigners to protect you from other foreigners, while your own citizens are taxed into poverty and your currency becomes worthless. In 2026, the U.S. debate over border security and immigration echoes some of these same tensions. We're spending billions on border infrastructure while simultaneously debating how to integrate millions of undocumented immigrants already here. I'm not making a political statement here. I'm pointing out the economic strain of managing a vast border with significant wealth disparities on either side. It's expensive to patrol, it's expensive to process, it's expensive to integrate. And like Rome, we're discovering that the costs keep climbing regardless of which policy approach we take. Let's talk about America's balance sheet in 2026, because the numbers are genuinely staggering. National debt stands at $36 trillion and climbing by approximately $1 trillion every 100 days. That's $106,000 for every American citizen. For context, the median household income in America is around $75,000. We're spending about $1.2 trillion annually just on interest payments. That's more than we spend on defense. We're literally paying more to service old debts than to fund our current military. Our debt-to-GDP ratio? Approximately 125%. For comparison, when Rome was sacked in 410 AD, historians estimate their effective debt load at similar proportions relative to their economic output. We've reached Roman Empire levels of fiscal irresponsibility, but we're moving faster and the numbers are bigger. Rome debased physical coins. We've gone digital. It's called quantitative easing, and it's far more efficient than shaving silver off coins. Since 2008, the Federal Reserve has expanded its balance sheet from under $1 trillion to over $7 trillion. During the COVID-19 pandemic alone, we increased the money supply by about 40% in just 2 years. Every time the Fed prints money, your existing dollars buy a little less. Your savings lose purchasing power. That steak that cost $8 in 2019, it's $14 in 2026. That's not inflation by accident. That's currency debasement with a modern PR team. Rome imported luxury goods from India, China, and Africa. Silk, spices, exotic animals for the games. They exported not much. Gold and silver flowed out of the empire to pay for imports. Eventually, Roman mines couldn't produce enough precious metal to cover the trade deficit. America's trade deficit in 2025 exceeded $1 trillion. We import electronics, clothing, automobiles, and just about everything else. We export dollars, debt securities, and increasingly, our manufacturing base. The Romans eventually ran out of gold. We haven't run out of dollars yet, but only because we control the printing press. The question is, for how long will the world accept pieces of paper in exchange for real goods? Let me show you something that should make every American pay attention. Rome's roads, aqueducts, and public buildings fell into disrepair. The government couldn't afford maintenance. By the 4th century, Roman roads that had stood for centuries were crumbling. The famous Roman baths closed, aqueducts broke and weren't fixed. The physical manifestation of Roman power slowly decayed. In 2026, the American Society of Civil Engineers gives U.S. infrastructure a C- grade. We have over 45,000 structurally deficient bridges. Our water systems are aging, our power grid is vulnerable, our roads are potholed. We're spending so much on debt service and entitlement programs that we can't afford to fix the basic systems that make modern life possible. The Romans stopped investing in the future because they were too busy paying for the past. By the late Empire, Roman society had essentially two classes, the super-rich aristocracy and everyone else. The middle class, small farmers, shopkeepers, artisans, had been squeezed out. Taxes kept rising to pay for the bloated government and military. Small landowners couldn't compete with large estates worked by slaves or tenant farmers. They sold their land and became dependent on the state or wealthy patrons. In 2026, the top 1% of Americans hold about 32% of the nation's wealth. The bottom 50%? Less than 2%. The wealth gap is the widest it's been since the Gilded Age. When the middle class hollows out, empires become fragile. There's no buffer between the elite and the masses, no broad base of prosperity to support the system. Rome learned this. Medieval Europe learned this. Will we? Late-stage Rome saw emperor after emperor rise and fall, sometimes within months. Between 235 and 284 AD, Rome had over 50 emperors. Political instability became the norm. Reforms became impossible because no one stayed in power long enough to implement them. Short-term survival trumped long-term planning. I'm not going to comment on American politics specifically, but I will say this. When political dysfunction prevents necessary economic reforms, when short-term thinking dominates long-term planning, when tribalism replaces problem-solving, empires don't course-correct, they collapse. Okay, so we've established that we might be on a historical treadmill heading toward economic chaos. The question you're probably asking is, what do I do about it? You can't fix the national debt. You can't reform the Federal Reserve, but you can protect yourself and your family. Let's talk strategy. Inflation isn't rising prices. That's the symptom. Inflation is the decreasing value of currency. When the government creates more dollars, each existing dollar becomes less valuable. Think of it like a pizza. If you cut a pizza into 8 slices, each slice is 12.5% of the pizza. If you recut that same pizza into 16 slices, each slice is now only 6.25% of the pizza. The pizza didn't grow, you just divided it into more pieces. That's monetary inflation. Your paycheck might say $50,000, but if the total number of dollars in circulation doubled, your purchasing power got cut in half. Here's what the wealthy Romans did when currency became worthless. They converted money into land, buildings, livestock, and precious metals. In 2026, you should think about real estate. Land and property tend to hold value during inflation because they're real, tangible assets. Yes, there are housing market risks, but over long periods, real estate generally tracks or exceeds inflation. If you can afford to buy rather than rent, you're essentially locking in your housing cost while inflation makes everything else more expensive. Gold and silver have been stores of value for 5,000 years. They survived the fall of Rome, the collapse of the Byzantine Empire, the death of the Spanish Empire. Central banks still hold gold reserves today. Ask yourself why. I'm not saying put your life savings into gold bars, but having 5 to 10% of your portfolio in precious metals? That's not crazy. That's insurance against currency debasement. The dollar is the world's reserve currency, for now. But the Romans thought their denarius would last forever too. Consider holding some assets in foreign currencies or international investments. I'm not talking about speculation. I'm talking about not having 100% of your wealth denominated in a single currency that's being systematically devalued. Here's something that survives every economic collapse: human knowledge and ability. The Romans who navigated the fall of the empire best weren't necessarily the richest. They were the ones with valuable skills: craftsmen, engineers, doctors, farmers, teachers. In 2026, invest in yourself. Learn skills that create real value. Plumbing, electrical work, coding, farming, medical skills. Develop multiple income streams. Build expertise that can't be automated or outsourced. Create things people actually need, not just want. When currency becomes questionable, skills become currency. Late-stage Rome saw the rise of local strongmen and community self-sufficiency because the central government couldn't provide basic services. I'm not suggesting we're headed for collapse tomorrow, but building strong local networks makes sense. Know your neighbors. Participate in local community organizations. Support local businesses. Build relationships based on mutual aid. Financial resilience isn't just personal, it's communal. This might seem counterintuitive during inflation. After all, you pay back loans with cheaper dollars, but personal debt is still a vulnerability. The Romans who went into debt expecting the economy to keep growing found themselves crushed when it contracted. Have an emergency fund. Live below your means. Don't assume tomorrow's income will always exceed today's. Here's the thing about historical parallels. They're warnings, not prophecies. Rome fell because Romans couldn't or wouldn't make the hard choices necessary to reform their system. They kept debasing currency because it was politically easier than cutting spending or raising taxes honestly. They kept expanding militarily because retreat seemed like weakness. They kept kicking the can down the road until there was no more road. But we're not Romans. We have advantages they didn't. Instant global communication, advanced technology, democratic systems that are imperfect but self-correcting, a history of innovative problem-solving, economic tools and understanding Rome couldn't imagine. The question is, will we use these advantages? Standing here in 2026, we're at a crossroads that Rome faced around 250 AD. They had about 150 years left before the Western Empire fell. They could have reformed. Some emperors tried, but the political will never materialized. The special interests were too powerful. The reforms were too painful. The decline seemed too slow to matter, until suddenly it mattered very much. We have time, but time runs out. The American economy is still the largest in the world. The dollar is still the reserve currency. We still have incredible innovative capacity, natural resources, and human capital. But debt grows exponentially, and compound interest works against nations just as powerfully as it works for investors. This week, this month, this year, audit your financial situation. Where are you vulnerable to currency debasement? Diversify your assets. Don't keep all your eggs in one basket, especially if that basket is pure cash. Invest in yourself. Skills, education, health. These appreciate while currency depreciates. Build resilience. Emergency funds, community connections, practical skills. Stay informed, not panic-informed, but rationally aware of economic trends. Rome's fall wasn't inevitable. It was the result of thousands of choices over hundreds of years. Choices to prioritize short-term comfort over long-term sustainability, to debase currency rather than face hard truths, to expand rather than consolidate, to ignore problems until they became catastrophes. We're making similar choices right now, in 2026, with our $36 trillion debt, our monetary expansion, our trade deficits, our political dysfunction. But here's the hope. We know how this story ended for Rome. We can see the warning signs. We have the tools to change course. The question is simply whether we will. Protect yourself. Prepare your family. But also, and this is important, don't check out of the civic process. The most valuable investment you can make isn't gold or real estate or even Bitcoin. It's a functioning economy and stable society for the next generation. The Romans left us ruins and lessons. What will we leave?